Hey guys, welcome back to Follow Me 11B. Discussions on current events, macroeconomics, and freedom and liberty from a veteran's perspective. Today, sorry about the bad lighting, but I am coming at you from a hotel room in Fond du Lac, Wisconsin. Got some unrelated business just here for a day trip. Next video should be back to normal. But today's video, the topic of the day will be the stock market, free fall, and what to expect this week. But before we get into that, I just wanted to remind everybody to be sure to hit the like button, or if you are watching on Rumble, press down on that boxing glove. Consider subscribing if you like the topics of macroeconomics and the current events from a veteran's perspective. Now, one last thing too before we get to the meat and potatoes. Don't forget Jared at Revert to Means. Revert to Means has a great channel on YouTube. He's also got a Gettr page on the Gettr website, as well as Instagram page, and he's got a lot of great insight, common sense into the markets and the real estate market in particular. But let's get to today's topic of the day: the stock market free fall last week and what we can expect this week. So let's start off with a CNBC article entitled, and this is from Friday, September 23rd, 2022, by Samantha Subin, and it's entitled, Dow Drops Nearly 500 Points to Close at a New Low for 2022 on Rising Recession Fears. Stocks tumble Friday to cap a brutal week for financial markets as surging interest rates and foreign currency turmoil heightened fears of a global recession. Let's see here, Dow finished at 29,590.41, or should I say spot. Let's see here, S&P 500 3693 spot 23, and Nasdaq Composite 10867 spot 93. The Dow notched a new low for the year and closed below 30,000 for the first time since June 17th. The 30 stock index ended the day 19.9% below. At one point, the Dow was down more than 826 points. It was a bad week. The major averages capped their fifth negative week in 6, with the Dow giving up 4%. The S&P and Nasdaq shed 4.65% and 5.07% respectively. It marked the fourth negative session in a row for stocks as the Fed on Wednesday enacted another supersized rate hike of 75 basis points and indicated it would do another at its November meeting. The market had been transitioning clearly and quickly from worries over inflation to concerns over the aggressive Federal Reserve campaign, said Quincy Crosby, the LPL Financial. You see, bond yields are rising to levels we haven't seen in years, and it's changing the mindset. How does the Fed get to price stability without something breaking? My guess, they don't. Meanwhile, the British pound hit a fresh, more than 3-decade low against the US dollar after a new UK economic plan that included a slew of tax cuts rattled markets that are fearing inflation above all right now. Major European markets lost 2% on the day. This is a global macro mess that the market is trying to sort out, Crosby said. Here's a chart. Dow flirts with bear market. You can see the numbers from back in March, over 36,000, and now today we're below 30,000 or thereabouts. So not great. Moving on, Goldman Sachs cut its year-end S&P 500 target because of rising rates, predicting at least 4% downside from here. Stocks positioned to suffer the most in the recession in the week's losses, with the S&P 500's consumer discretionary sector falling 7%, energy slumped 9% as oil prices dropped. Growth stocks, including big technology names like Apple, Amazon, Microsoft, and Meta platforms, fell on Friday. So likely, in my opinion, too, they're going to keep falling this week. But back to the article. Actually, let's skip to another article. This one's from Reuters, and this is from September 23rd, 2022, entitled Wall Street Week Ahead. Investors wonder when vicious sell-off in U.S. stocks will end. New York, September 23rd. A week of heavy selling has rocked U.S. stocks and bonds, and many investors are bracing for more pain ahead. Wall Street banks are adjusting their forecasts to account for a Federal Reserve that shows no evidence of letting up, signaling more tightening ahead to fight inflation after another market-bruising rate hike this week. The S&P 500 is down more than 22% this year. On Friday, it briefly dipped below its mid-June closing low of 36.66, erasing a sharp summer rebound in U.S. stocks before paring losses and closing above that level. With the Fed intent on raising rates higher than expected, the market right now is going through a crisis of confidence, said Sam Stovall, chief investment strategist at CFRA Research. If the S&P 500 closes below the mid-June low in the days ahead, that may prompt another wave of aggressive selling. Stovall said this could send the index as low as 3,200, a level in line with the average historical decline in bear markets that coincide with recessions. A rout in bond markets added pressure on stocks. Yields on the benchmark 10-year Treasury, which move inversely to prices, recently stood around 3.69%, their highest level since 2010. Higher yields on government bonds can dull the allure of equities. Tech stocks are particularly sensitive to rising yields because their value rests heavily on future earnings, which are discounted more deeply when bond yields rise. Goldman Sachs, meanwhile, cut its year-end target for the S&P 500 by 16% to 3,600 points from 4,300 points. In my opinion, that might be a little generous too. Well, moving on. Based on our client discussions, a majority of equity investors have adopted the view that a hard landing scenario is inevitable. Wrote Goldman analyst David Costin. Investors are looking for signs of capitulation point that would indicate a bottom is near. Kevin Gordon, senior investment research manager at Charles Schwab, believes there is more downside ahead because central banks are tightening monetary policy into a global economy that already appears to be weakening. It will take us longer to get out of this rut, not only because of slowdown around the world, but because the Fed and other central banks are hiking into the slowdown. Gordon says it's a toxic mix of risks for risk assets. Fear often leads to short-term bottoms. S&P 500 is currently trading around 17 times expected earnings, well above its historical average, which suggests that a recession is not yet been priced into the market, he said. A recession would likely push the S&P... Okay. The only way we see earnings not contracting is if the economy is able to avoid a recession, and right now that does not seem the odds-on favorite. Yeah, I think you are correct there, sir. All right, so that's pretty much all I've got for articles today. But let's talk a little bit about that. What can we? Let's go back to the original question. Stock market free fall. What can we expect this week? Well, in my opinion, we can certainly expect more volatility. Probably a lot of it. Likely another down week, another weekly loss. How much? Who knows? But I feel confident that we are gonna probably have another, in all probability, another 5% loss. But who knows? Maybe 20. And I'm not talking this week. I'm talking the next couple weeks. But I mean, this week I'd be confident to take a stab in the dark and say 5%. I am not a economic analyst, although I play one on YouTube. But I would see that I can see that 5% seems like it would be fairly probable based on all the macro forces in play right now. Don't take this as a economic advice either. That's not what I do here. But I could also see S&P 500, finishing up, in the 3,000 to 3,500 range, maybe 3,250-ish by the end of the year. But we'll have to wait and see about that. But for this week, definitely more volatility. That said, I don't have a crystal ball. But when you combine aggressive deficit spending, with global uncertainty, shall we say, global high food prices, high energy prices, high housing prices, high car prices, global instability with the Ukraine situation, the Taiwan situation. I mean, that just spells a recipe for disaster. Now, is it going to happen this week? Is it going to happen next week? Is it going to happen a month from now, or 2 months from now, or 6 months from now? I think smart money is first quarter next year, summer next year. I would put more money on for sure. But I'm thinking we're going to ride this thing out. It's just the wave is just going to keep getting higher and higher up until the end of the year, and then it's just going to come crashing down on our heads beginning of next year, in my opinion. But again, I don't have a crystal ball, but that's my prediction. But maybe I'm wrong. Love to hear what you guys think. Please post your comments below. Don't forget, we are growing. We are Follow Me 11B on YouTube, Twitter, Gettr, Facebook. We're also at The Real Follow Me 11B on Instagram and Rumble. And don't forget to check out Jared. He's got a great channel full of real estate stuff, just everyday common sense stuff, some prepping stuff. So check him out at Revert to Means channel on YouTube. And we will see you all on the next video.